Citi is sticking with its bullish playbook, focusing on 5 stock selection narratives: AI at a reasonable price, positive ROE trend, inflecting growth, return on growth capex, and high earnings sharp. So let's bring in Drew Pettit from Citi to break this all down. Drew, welcome back. Last week you told us the market's fully valued. This week you got some themes. Which one of these do you think is the most counterintuitive?
I would say the inflecting growth theme. It's funny, we're talking about the government reopening, and in data, will it be good? Will it be bad? What will the Fed do? And everyone keeps talking about growth, growth, growth. It's actually the cyclicals that get really interesting next year. So it's been 3 years where we've seen earnings in a downtrend. They're probably down 20% or more off their post-pandemic peak. And that's where you're going to see the best growth inflection in the next couple of years. So I'd say the cyclicals, not talked about a lot, but going to have a real trend change that should be the catalyst to get investors interested again.
We're about to get a lot of data that we've been starved of for quite a while. Government data, of course, but then also some sales data through the holidays, the real-time stuff. Then, of course, the earnings reports into January and February. What's the most important data to feed into these narratives that's going to tell investors which way to go?
So it's funny. It's going to be a little bit of a mosaic on the consumer. And then I'm going to say the tariff story. When you think about cyclical and inflecting growth, it's been so bad that as long as we don't see data get much worse, if employment holds in, if spending is just okay, and companies find a way to manage the tariff impacts, out the other side, earnings look pretty good. So it's getting some of the bad in the rear view mirror and seeing those macros, while maybe weaker, just not hitting recessionary types of levels.
How much do technicals matter here, Drew?
Look, we don't factor that in at all on these themes. It's all fundamentally based. Yeah, price always matters. So technicals, in a sense, do matter. When you really think of the baskets and the themes that we're talking about, they're high beta. So if you have conviction that we're not going into recession, if growth companies can still get return on their capex, and compounders can, well, keep compounding earnings, you shouldn't be shy to have beta to those types of themes.
And so I assume this stretches into 2026 as well.
Yeah, it's honestly something you should be thinking about putting money to work on pullbacks for these higher beta types of themes, or if you have cash or excess fixed income allocation sitting on the sideline, this is the type of equity risk you want to buy. 2025, the end of this year, and into 2026, when you're fully valued, it means fundamentals and idiosyncratic stories matter.
And real quick, Drew, explain the new defense, because traditional defensives aren't working.
Yeah, look, the problem is when you don't have beta in an up market, yeah, it helps you on the pullbacks, but it takes way longer to recover. So our way of thinking about this is don't buy just low earnings volatility. Buy relatively attractive growth relative to that earnings volatility. So that's why we get to compounders in our high earnings sharp basket, not just low beta stocks.